Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate investment expert Chad Sutton. Now, Chad is managing partner at Quattro Capital, a multifamily investment firm focusing on value add properties in growing markets. Now, previously working with NASA, GE Aviation, and GE Renewable Energy, Chad hones his intentional negotiation and relationship building skills to drive Quattro Capital's growth. Now, beyond work, Chad is a devoted family man, indulges in hobbies like golfing, playing guitar, and renovating his historic home. And so, guys, without further ado, I'd like to welcome our guest for today's show, Chad Sutton. Chad, how you doing today?
Kevin, it is a pleasure to be here. I love when seasons change. As we're recording this, it is brand new fall weather in Nashville, so you can see I'm dressed down in my fall attire here and loving life. So, yeah, happy to be here, brother.
Yeah, no, excited to have you here, and I agree with the weather change. I'm down in the Tampa, Florida area, although we had a cold front come through here about 2 days ago, and can't really tell, but I've got this is actually a flannel. So we do wear flannels in Florida every once in a while. And I've got my windows open today, which doesn't happen all that often here in Florida. It's either really, really hot and you don't have the windows open, or it reverts to fairly cold to where it's a little too cold to have the windows open. So very few times we have the in between, which we're enjoying right now. So in any event, excited for the weather, excited for the change. We don't get the leaves, the color of the leaves changing like you guys do, but we get other benefits. So with that, let's move on to the fun stuff, Chad. Let's talk about I want to dive into the meat and potatoes of the business, Quattro Capital, what does you guys do. But before we go there, let's back it up a little bit. I gave you a very brief introduction. Would love to learn a little bit more about you, your background, and how you found your way into real estate.
Yeah, so going back into the background, you heard NASA and GE in there. So naturally, I was an engineer, for a lot of years. I was the kid growing up playing with erector sets and Legos, and I was really good at math. And so, look, Kevin, the world told me you should be an engineer, and I listened. I went and got a couple of degrees and went to work for first NASA back when the space shuttle was flying. So I just dated myself a little bit there, but. After the space shuttle was retired, went to work with General Electric in the private sector, where I spent a good number of years on the design and manufacturing side of aircraft engines. So if you've flown on any kind of commercial airliner that looks like it's new in any regard, I've probably touched that engine. I was a smoke and fire guy coming from rocketry on the space shuttle to aircraft engines. I was combustion, so that was the natural transition. Both of them have smoke and fire where you light off fuel and stuff, and so that was a pretty fun endeavor for a lot of years. But I tell you what I learned. I did a lot of really cool work. I developed a lot of really cool technology, and years down the road, I looked up and I realized, well, gee. There's my senior engineer and there's my principal engineer, who's the even older version. And I was like, okay, this is me. This is me. What I'm going to be doing the rest of my life. I'm going to be really good at this. And there's only 3 companies in the world I can work for, and I now work for one of them. So it wasn't when I had that realization, I was like, this isn't really what I want anymore. And further, I think that was the year I had a couple of patents come through. So if you want to check out Chad Sutton combustion patent, you can see some of the stuff I used to work on. They're public knowledge now. But I had some of those come through, and I mean, some of that technology really put us into a major market share. And I think I got $300 of a thank you and maybe a 3% raise that year and a smack on the rear end. So I was like, wow, okay, this is not how people get wealthy in this country. Now, granted, yes, I was using GE resources when I developed it, so of course they own it. But that was the realization of what do I want to do from here. And then around that time, you'll also remember, big GE, that stock price went from about $50 to $5 over about a year period when things started to fall apart in the Jeff Immelt era. And I was plucked for a very unique role where I got to really run around the world as a kind of an internal consultant. And, GE has manufacturing plants everywhere, literally everywhere, Asia, Scandinavia, Europe, you name it, right? So I had a green Amex with GE's name on it, and I got to fly everywhere in the world for several years. And my whole job was, how do you improve the profit and loss statement? Like, how do you lower costs, increase profitability, manufacture things better? And because I had engineering and business knowledge, that was a natural fit. So imagine this young, 30 something kid flying around the world with an unlimited Amex, And the whole job was, how do you save the company money? Well, there was a lot of negotiation and culture change and all that kind of stuff that had to happen to do that. And so I got some really unique skills of P&L management and international negotiation and culture change and all that kind of stuff that had to go with, making moves like that in the industry. So fast forward a little bit further, that led to a global executive role in supply chain, where I landed in the GE Renewables business. Spent some time there, doing a lot of international purchasing negotiations and things of that sort, like to the billions of dollars of heavy electrical components and things of that sort, like that would go in a wind turbine, right? And this is where my corporate America story stops. I got really good at this job, and my whole job was taking everything from my suppliers, and I was good at it. So for me, I was big bad GE with the checkbook. They were little mom and pop suppliers, and my decisions literally could make or break their profitability for the year, right?
Hmm.
So to me, I didn't like being in a position where for me to win, others had to lose, Kevin. It wasn't a good moral alignment for me. And so let me step to the side. There's a parallel track going on in my life at the time, and this is where real estate comes into play. My family, I'm a third generation real estate. I didn't really know it until my late 20s. I worked on these houses growing up, but I never knew that grandma and granddad owned them, right?
Mm.
Well, granddad passes away in 2016. This is a major moment in my life. He was a major influencer on all things that I did. And I got involved in the family business with one of my business partners, who is my aunt, second generation. And this is where the light bulb started to go off, because over a course of a year or two, there was a lot of properties sold, some bought, some invested in, and wouldn't you know it, we tripled the value of the portfolio with a little bit of work in just a year. So that's where we started to figure out, well, gee whiz, there's something to this. Let's systematically do this, right? So we start to look at how to replicate, and this is a single family business at the time,
I was going to
single
ask,
family
yeah, are these
rentals.
the single
Yeah.
family rentals? Okay.
These were single family
Hmm.
rentals at the time. So of course we've experienced how they don't scale well, and some of the economies of scale problems on expenses and repairs and maintenance and all that kind of stuff. And we start to look at how to expand it. And after, a close survey of all the different asset types out there, like a lot of others did, we naturally landed on, multifamily as a concept because of the immense supply and demand discrepancy that was there. So we started buying those with family money, and then we started buying them with investor money as well. And the rest is history. So now we control about $250 million in assets across 6 states. We still have some of the single family homes, but not near as many. And this is our primary asset class now. So it's been a lot of fun growing, and that's where we are.
Okay. No, I appreciate that background, and just curious as to when the transition actually happened. When did you step out of your W-2 and go full time in the real estate?
So I did it in parallel for a lot of years. As an
Okay.
engineer, I had this whole plan where I wanted to, do it and then make a certain amount of money and then exit. And it was actually 2020 that forced me to exit. So, and
Got it.
remember, I said I was an executive in supply chain and I was running a real estate business. Well, both were doing very, very well. But in 2020, we had a situation where all of a sudden there's this thing called a global pandemic and an eviction moratorium and all sorts of stuff we'd never heard of before in this industry. And so real estate started taking, 15, 20 hours a day as we're trying to figure out how in the world to adjust. Because if you didn't adjust, you didn't survive at the time, right? Before that, I'm in supply chain as an executive there. So I had a very tightly scheduled day. My teams were in Europe and Asia. I'd work from about 4 a.m. until noon or 1 o'clock. And then I'd work from 1 until 7 when the kids got home, and then go back to work after they went to bed. So I was already running pretty stretched with the two ventures that I had going. But when one of them and both of them started taking 20 hours a day, because what I also saw was supply chain started shutting down in China and then Europe and then India. And I saw COVID coming across the world.
Mhm.
And of course, we're all thinking it'll never happen here. Even when it was all the way in Europe and just one plane ride away, we were still thinking it'll never happen here. Well, guess what it did? And that was my ultimate jump, where I was like, look, I'm not happy in this role. I want to grow this business. And ultimately, for various reasons, I was able to exit corporate America and save a couple of jobs on my team where there were layoffs coming, you know.
Hmm.
And so it was an I know I'm going to land on my feet type of thing. So I officially pulled the ripcord in 2020. I was not ready to do it, but after I did, the company grew 10x after that. So in the following years, so
Got
it
it.
was necessary. And sometimes you just need a little push off the ledge to make the jump.
Got it. No, I appreciate that. So would love to get a sense of, you made the jump in 2020. Obviously everyone, at least for the first couple of months of COVID, if you were in the real estate rental space, you were wondering whether or not you were going to get rent checks in. And
That's right.
what we saw, maybe not across the entire country, because there are a few markets, speaking to like San Francisco or New York City and Chicago, things like that, where they're still experiencing challenges. Landlords are with collecting rents and back payments and evicting folks, what have you. But for the most part, folks paid their rent on time. We saw an increase in demand like one could never have expected. We saw rental increases like one could never have expected, double digits for a number of years in a row, and it put rocket fuel behind the multifamily industry and inflated values, what have you. And so I mean, it was rates were really low at that point in time, and it was kind of a free for all. Everyone was buying and growing exponentially. And however, now we find ourselves in a very different time, right? Where they not necessarily the other end of the spectrum, but rates have gone up dramatically over the last year, and it seems to have put a major halt on buying. I know a lot of multifamily folks, not just multifamily, but just real estate folks in general, like you and I, that are pencils down, right? Like they can't get deals to pencil out. There's still too much of a delta between seller expectations that are still expecting prices of 2020, 21, 2022, and haven't reset their kind of their pricing adjustments to what the world is today. And so there's just lots of factors to play with there and that are involved. And so I just would love to get a sense of where you guys are at today in your business. Are you still actively buying? How are you making deals happen? Given the volatility in the marketplace, and just any additional insights that you'd like to share.
Yeah, and I think it was a surprise to a lot of people that rents ran up the way they did. But if you understand how money works, it wasn't a surprise at all. I mean, what
Sure.
we did, what we did was we literally doubled the money supply in this country, right, in about 18 months. Go
Mhm.
look at M1, M2 money supply if you don't believe me. And so all that happened there is like, what happened? We sent out a bunch of stimulus checks when unemployment spiked, and put a lot of money in bank accounts and all that money in people's hands, which then went to their bank accounts. And what do banks do? Banks lend out every dollar they have in your deposits tenfold back out in loans. And so, sure, we slammed rates to zero to stimulate growth through this time, and we pumped cash into it. That was the whole quantitative easing. And so prices of everything began to skyrocket. One, because we shut down supply chain for the first time since Noah's Ark. I mean, come on, guys. We shut down the world. And then, everyone wanted their things immediately. They had money to buy, money to spend on it, extra money to spend. And so prices went up from houses to rent to, groceries to whatever else because of the double whammy of extra money in your pocket to spend and extra pressure on the supply. We had a supply and demand imbalance that was augmented on both sides. So it's not surprising to me at all that rents ran up the way they did. It's not surprising that values ran up the way they did, simply because rates were effectively zero, and some money was free. And these net cash flows, net operating incomes were going through the roof. So there was a lot of buying on pro forma that happened. It took a lot of discipline not to do that. But where are we right now? So we're in a situation where things have reversed just as abruptly as they got great. And I think we all hate to look at the fact that things are going to change for the worse. And so where are we? We're in a situation where most of the short-term debt that was taken on from 2019 to 2021 is starting to mature. And I say starting as in there's been some people pull extensions and such, and you're just now getting to the point where you're starting to see lenders are saying, no, you have to pay, either cash in, refinance, or get out, or we're going to take the property. Now you have an interesting balance where I think lenders also learned their lesson from 2008, and that they don't want a mass foreclosure situation. That doesn't help any lender's solvency. Okay. But you do have a situation. underwrote a deal just this morning, Kevin, where my team did, and I was reviewing it. We are not pencils down, because if your pencils down, you don't know what the hell's going on because you're not writing deals. But we're still looking at things, and there was a massive gap between buyers and sellers, on where pricing went, because interest rates spiked, so cash flows got whacked, but people still paid what they paid for the property. And it's going to take a long time before these sellers are willing to say, well, gee, I know I just bought this 3 years ago at 30 million, but now it's only worth 22 or something like that, right? That's a major haircut to take. And it's starting to happen. So the one I looked at this morning, they bought it in 21 for 31 million, and I sent an offer in at 25, because that's all you can make it pencil at right now. So I think what is happening, it takes about a month to 6 weeks, 4 to 6 weeks after a change in the market for the market to acclimate. And we had a change every 4 to 6 weeks for 18 months. Okay. So the gap between buyers and sellers got so wide, but it is collapsing back together. And if you ask me where we're going, we're going to see some isolated distress. You're seeing lenders in general work with borrowers who are still creditworthy, especially in the office space, not just multifamily. Sure. But, we're going to get to a point where the interest rates will stop rising. They will. And they may even start falling, but Jerome Powell will never come out and say that right now. We're going into an election year, so there's a 50-50 shot that something happens and they start to fall to make the climate a little less painful before, voting happens. And so, cap rates will probably continue to increase, meaning pricing will decrease until a point that reaches equilibrium, and then we'll start to see a lot of trades again. So there's about to be a pretty big wealth transfer, I think, from some of the money that made maybe some not so good short-term high price decisions, especially in the Sun Belt. And I guess we'll see where we go from there.
Yeah, no, fantastic. And are you seeing the kind of the same thing across the board with your competitors as well?
What do you mean in terms of distress and such?
Yeah, no, not as far as buying activity. I mean, transactional volume is down 90%, but I mean,
Oh yeah, yeah.
Is it pretty much a general sentiment across the board? I would love to know. I guess at this point in time, it's really I feel like it's kind of everyone that's holding on to their assets that they have in their portfolio. It's kind of all hands on deck. Okay, guys, well we should always be focused on asset management, right? But now let's kind of double down on asset management. Let's really focus on retention rates and ensuring that we're keeping. It's always obviously less expensive to keep the existing tenants that you have in place rather than find new ones to fulfill those vacant spots. And so is there anything unique that you guys are doing, or any strategies that you guys are putting in place that is just really helping put some rocket fuel behind the asset management piece of your business?
Yeah, I think that's super important right now, because what we haven't really gotten to, that was just the interest rate problem, right? We haven't
Yeah.
even gotten to the fact that inflation really hit operating expenses pretty heavily, namely
Mm-hmm.
payroll, namely repairs and maintenance. Insurance is in crisis across the country, especially down in Tampa, Florida, right? I'm
Yeah,
fortunate that I don't own down
absolutely.
there. So, what you're also seeing is we got real used to expenses staying flat, income lines moving pretty quickly, as an industry. And so NOIs went up very quick. What we're seeing now is your below the line expenses, meaning your debt is 2x, in some case 2.5x more than what it was when you started. If you need to make a capital decision, but no matter who you are, you have felt somewhere between 10 and 200% increases on insurance. Probably 20 to 30% increases on payroll. And so no matter how good you are at moving the income line, doing renovations or adding new income streams or whatever it is you're doing, you're fighting the expense line, counteracting a lot of what you're doing. So I think the more attention needs to be given on the expense line than has been in the past. You can't just let the management company run wild and do what they're doing and assume it's going to be acceptable, because I've seen some buildings climb to over 60% expense ratio, which is not really acceptable. So what are you doing, right? It's time to be, you really need to start to have experts in place on property taxes, someone to help you negotiate what's going on there. You got to have someone, helping you with insurance, getting better portfolio strategies. Those are two major line items you got to get a hold of. And then everything else, it's what do I really need to spend? To your point, keeping customers is much cheaper than acquiring new customers. So rather than blowing a lot of money on marketing and trying to acquire new leads, what are you doing to retain them? You got to be adding community value, making sure people want to stay. Are the people they're interacting with, are you getting good reviews on them? It's all the basic stuff. This isn't
Mhm.
like a new pill you take. It's just, how do you be a good human? And how do you make sure that your people working for you are good humans, and you're making a good first class human experience for the residents in your building? And that in general keeps them in place and helps them agree to pay, whatever renewal rate you need them to pay to stay there and keep moving your income line, you
Yeah,
know?
and I should ask you before I ask that question whether or not you guys have your property management vertically integrated or if you outsource to a third party company.
Yeah, no, great question. By design, we do not outsource third party. We're all but intertwined with one company, so we kind of call them our partner, but we are separate entities, and they're big enough and in enough areas that we are able to kind of be nimble and go where we want to go. They have, vertical construction management in house. And so for us, that, the operational side is not a side that we want to ever have in house.
Mhm.
But it is, we focus more on the equity and the acquisitions and the overall strategy of the portfolio.
And where are you guys at? I see your portfolio is kind of spread out amongst Southeast and then a few select other markets, even some up in the Northeast. I mean, where are you spending most of your time, energy, and focus nowadays?
Yeah, nowadays, so we got pretty excited about Texas. I think Texas has a correction coming just due to some other forces that are unique to Texas, and Florida's probably the same. We are mainly focusing in the state of Tennessee, northern Alabama, northern Georgia in some areas, but Georgia's getting tough to do business in, and Indiana is a great market, and where it's kind of overlooked, I think, more, but it's that's where we're spending most of our time.
Indianapolis or
No, more like Evansville, South Indy.
okay, okay, got it, good deal.
Yeah.
What give me some additional context on Quattro. I mean, anything that you guys do that helps you guys stand out amongst the many other syndicators and equity groups that are out there. I mean, any charitable endeavors that you guys are involved in, and how do you like to to give back when you're not out there hunting deals? I mean, what do you guys do as a team to make the lives better for all those that you touch?
Yeah, I love that you asked that question because, Kevin, there, what we're doing is not a novel concept. What any of us are doing is not a novel concept anymore. Some of us were doing it before it was cool, but now it's cool. Everyone and their mother, it seems today, is syndicating equity for a real estate deal of some sort, or some plain vanilla plus this flavor type of real estate endeavor. And so I think what's important when you're looking for a team to partner with is what are the intangibles they bring to the table with it, right? So if you look on our website at thequattroway.com, you'll see, four pillars that kind of run our mantra and our offerings. And, they are people, property, profits, and philanthropy. And look, people use property and profits, the middle two, all across the board. I mean, there's a lot of people doing, real estate investing of sorts to buy a piece of real estate, put some money into it, or operate it better, or whatever value proposition you bring to the table, and sell it for more. I mean, that's just the investing side. The difference is we look at this business for what it is. It's people first. You have people who are your residents. You have people who work for you, who you create jobs for. You have people who invest with you. It's all about providing a first class human experience. And so, we're going to be the team who make decisions based on the people living in the buildings. We're going to make monetary decisions based on the people invested in our deals. People are not just numbers in the offerings that we have, and that's kind of a general consensus we got. We didn't know what to call it, so we called it the Quattro Way. And then you come back and you look at philanthropy, and that's just coming back around and taking care of people. So if you list out the four pillars again, it's people, property, profits, and philanthropy, coming back around and taking care of people. We have a unique situation where we've set up it's called a donor advised fund, but the Quattro Giving Fund is the name of it. And so we put a chunk of our profits in there into our fund, and then we also raise equity, charitable equity from our investors and others into that fund as well. And what's cool about that is we then have partners in each city that we work with who focus on, foster care issues, or shelter to housing, or homeless to shelter type situations. And like an example is we have like what 2,500 units that we manage, in several cities. And so how can we simply use some of those units to fund a charity, let them go find people who need safe, quality, and affordable housing, need it subsidized, or get on a payment plan where they can get, back into self-sustaining situations, and we fund them, they use our units. And so it kind of becomes this regenerative circle where, we're putting some of our product out there, and people are being able to come in and use that, helped by the charity that we fund. You see what I'm saying? And so
I
you
love it.
really have to look at this whole thing as a circle. It's people first to come together around a property, hopefully generate a profit, some of which is used for philanthropy, coming back and taking care of people. So that's called a first-class human interaction, and that's what we do that's different.
I love it. I love every bit of that. No, I appreciate you sharing that. And Chad, for those that want to learn more about you and your group and your different offerings, your charitable endeavors that you're involved in, where's the best place to find you?
Yeah, the best way to go is just check out our website. I mean, there's pictures of myself and my four partners, everything about us, videos. You can go check out, assets we've worked on. It's just thequattroway.com. That's Quattro, as in the Audi Quattro. But the Quattro Way, it's our way. It's how we do it, and we couldn't come up with a better name, so the Quattro Way it is.
All righty, good deal, good deal. And you also have a podcast. I didn't realize that until right now. So you want to tell us a little bit more about that?
Yeah, absolutely. So, the podcast is called Real Estate Runway. It's actually a podcast and YouTube channel and all the things, so it's on TikTok, anywhere you consume content, you'll probably find it. But it is a show where we don't just talk about real estate. We really talk about all things alternative investing and mindset and lifestyle and things of that sort. So, if you're of the mindset that you want to, start acquiring assets, whether it's passively or actively, you want to start looking at lending strategies or whole life insurance, or, whatever it is people do to generate wealth in this country, that's not mainstream, we talk about it on that show. And so the best way to find that, you can either look up Real Estate Runway on any platform that you are listening to, that's
Mm-hmm.
Spotify, Stitcher, if it's still there, Amazon, all that kind of stuff. It's everywhere. And, or you can just go to thequattroway.com and click on podcasts, and you'll find it all there as well.
Okay, good deal. That's funny. You make the joke about Stitcher. I have no idea if that's around. I
You
mentioned it,
know,
but I don't even
I
know if it's
keep
still
getting
around.
emails. I think they got bought by somebody, but it's like, well, we're still
Okay.
public. Like my team is still publishing content to Stitcher, but I heard Stitcher's not there anymore, so I don't
Yeah,
know.
yeah, makes sense. Well, good deal. Well, Chad, I really appreciate you coming on the show. It's been a lot of fun having you. Appreciate you sharing your insights and all your knowledge and wisdom.
Yeah, absolutely. Thanks for having me. Hope to do it again soon.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.